How to snag a 0% tax rate in retirement. Interesting. Josh, you saying I don't have to pay tax? I'm saying you don't have to pay tax. Here's an article from the Wall Street Journal. This goes back to March 31st, and somehow it just came across my my screen here. Actually, I now have a subscription to the Wall Street Journal. I actually don't read it, but I like to do research on the past, you know, for books and things I'm creating. So I bought for like $100 bucks, like $1 a week for 52 weeks. So I am looking at some. I actually don't read the Wall Street Journal or the New York Times. I subscribe to both for very minimal cost, simply because I like to look at the histoire. That way we can see, oh my goodness, inflation is a modern phenomenon. We look back in 1908. Inflation was a significant issue in the New York Times back then too, but there was no Federal Reserve. There was no Federal Reserve, so how could there be inflation? What? I thought the Federal Reserve ruined everything. Yeah, so dumb. So dumb. All right. So here's Laura Sanders. Saunders, I'm a big fan of Laura. I've been reading her for years, actually. And good article. And we're going to go into a little bit with Right Capital, too, because I want to show you how this works. All right. The U.S. tax code has a 0% rate on investment income, even for Americans with significant assets. The zero rate isn't a secret. It's been effective since 2008. And nearly 11 million filers qualified for 2020. What? 11 million? That total included about 34,000 filers who earned more than $1 million or more. I don't know about that. How'd you get a 0% if you earned over $1 million? Let's keep reading. The rate only applies to capital gains and qualified dividend income in taxable accounts, as you well know. All right, it's not from tax-sheltered IRAs. We all know this. So, if you're watching this video, I know you know this. All right, so here's where she makes a mistake. In addition, the income limits for the 0% rate are higher than they seem. Nominally, the rate disappears for single filers with basically $45,000 of income, and joint couples with $90,000. Now, she's making, she's not literally making the mistake, because Laura knows this, but she should have, well, I can't tell people how to do their stuff. Basically, that's after the standard deduction. She's talked about taxable income. We want to look at AGI. So AGI is basically 120 for married filing jointly and 60 for single people. AGI. All right, so you start with your adjusted gross income, and then you build down from standard deductions and itemized deductions and whatnot. I wish you would have done that. And I think a lot of people are going to say, I make $100,000. I can't qualify. Oh, yes, you can. Yes, you can. Because you're in the 12% tax bracket. You got to stay in the 12% tax bracket. However, taxable income, oh, she does talk about, okay. I read this article. I guess it's been a couple weeks. It's been sitting on my toolbar. But, however, taxable income is smaller than AGI. So there she goes. Okay, so my mistake, Laura, I take it back. You get $27,700 standard deduction for married people, and it's basically $14,000 for single. So there you go. All right. So I missed that. So good call, Laura. Say it right there. So basically, if you're $60,000 for single, or you're $120,000 for married filing jointly, you get this 0% tax rate on your capital gains, long-term capital gains, and qualified dividends. And again, hang tight in there. We're going to show you how this works. Kent Ferson, a 68-year-old retired engineer in San Diego. He has a taxable account and a rollover IRA, right? But what he's doing is, instead of doing Roth conversions, he's relying on 0% taxes on his dividends and capital gains, because he keeps his tax rate below the 12%. So he doesn't want to do Roth conversions. Some frugal souls managed to stay in the 0% for years. Dave Hollowell, a 6-year-old retired computer program living in San Francisco who isn't married to his long-term partner, says his income has been the 0% for dividends and capital gains since 2013. He even squeezes a small Roth IRA conversion while staying in the 12% tax bracket. Good stuff. Because of how the 0% rate works, taxpayers whose income is all long-term capital gains or qualified dividends will more easily qualify. That's how 34,000 millionaires were able to use it on a Porsche. A Porsche. All right, come on now, Laura. Yeah, so she says right here, the total included about 35,000 filers earning $1 million. All right, so I said there's no way you're earning $1 million and having a 0% tax rate. So she now is saying a portion. All right, that's a big difference, Laura. Come on. All right, so let me just see anything else on here. It gives a example. Say a couple's taxable income, that's after standard deduction, consists of $90,000 of IRA withdrawals and pension. The 0% rate is $89,000. So net long-term capital gains and dividends for them would be 15% because they're above they're in the 22% tax bracket. But the couple can lower their IRA withdrawal and replace that income with eligible capital gains and dividends. They'll have room to benefit from the 0% rate and reduce their overall taxes. Yep. The 0% rate probably won't be available once you're taking RMDs, 100%. Now is jumping in Right Capital. All right, and I want to show you, this is what I was talking about my Gen X webinar I did on Thursday. So if you're interested in that, bouncing the ball because I got my pool back there. Look at that. Oh, but a pool is a bad investment. Yeah, you don't invest in a pool. You invest in the pool for fun. All right, you don't invest in the pool for return on investment. That's stupid. Look at that. Look at my jump shot. Shoo! All right. Anyway, so we're going to jump into Right Capital. So on my Gen X webinar I did on last Thursday, which 21 to 22 people showed up for. Much obliged. Probably do it again. I very much enjoyed that, actually. We talked about basically having a 0% tax rate in retirement. All right, we want to be poor on paper, and we do that with Roths, we do that with taxable accounts, and we do that with Social Security. So we're going to go into, who do I got? Susie Sample up here. Yeah, Susie and Bob Sample. All right, we're going to go to Bob and Susie Sample, and what we're going to do is going to profile. And I think they're 70, 66. All right, so Susie's 70. And Bob is 66, and they live here in Georgia. All right, with me so far? We're going to have income. We're going to say they have $30,000 of long-term capital gain. $30,000 of long-term capital gain. Plus, Susie's got $3,500 in Social Security, so that's $42,000 right there. Plus a $30,000 long-term capital gain. So if my math is correct, 30 plus 42 is $72,000. And then not survivor benefit. Then Bob's got another. 40, is that 35? Is that 42,000? Hold on a second. Yeah, it is, right? Hold on. Now I can't remember. Hold on. Let me just get the calculator. 35 times 12 is 42, right? Yeah, 42,000. All right, cool. So they got 42,000. They get 84,000 of Social Security. 42 plus 30. Look at that. Oops. Oh, did I do minus? Anyway, they got 84,000. 84 plus 30, oh boy, equals right there. They got 114,000 of gross income these guys have. All right, so let's take a look at what we're looking at. We go to retirement. We're going to say, how is it going to shake out here? We don't care about this right now. I'm just showing you an example. The benefit of maximizing your Social Security and minimizing your required distributions. Yeah, so they got their income flows right here in 2024. Is 112,040. So they got 82,000 Social Security and 30,000 of long-term capital gain. How much are their taxes? $656. $656. So let's go to 1040. Hold on a second. I got to sneeze. Right Capital's wrong here. They got them living in. I think we were living in Georgia. Did we live in Georgia? Because they should not have any taxes. Because in Georgia. Yeah, so Right Capital didn't get that right. So the state income tax for, and every now and again, Right Capital have an issue on the state stuff. In Georgia, you don't have to pay taxes on your first $130,000 if you're married, filing jointly, and you're over the age of 65. So just keep that in mind. So that tax payment is wrong. How do I know that? Because we go to tax, we go to 1040, and we see they got no tax. All right, oh, 82,000 Social Security, but only 29,000 is subject to taxation. Oh. 30,000 long-term capital gain. So we take our $58,000. That would have us in a married family. Yeah, that is our total income. All right, our AGI. We subtract our standard deductions, and our taxable income is $28,000. So you think you'd still be in a 10% bracket, right? No, you wouldn't, because the taxable income, the 30,000 that taxable income is in what? Long-term capital gain, which means we're still in the 12% tax bracket, so it's tax-free. Pretty cool, isn't it? So right there, there's our federal income tax bracket at 10%. So we pay no income tax at all on $112,000. So check this out. Let's have her making $40,000 instead of $30,000 long-term capital gain. Let's see what that does. Boink, 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 boink. We're just going to go over here to tax. And we're going to look at that. And this is the 1040 is a federal tax. It jumped up right there. That should still be okay. So we go to details and 1040. 40,000 of long-term capital gains. 82,000 of Social Security. They got $122,000 of income, right? Yeah. Yeah, $122,000. They got to pay $677 of taxes because they went above the into the 22% tax bracket by 40 plus 82 is 122 by about $2,000 or something like that. I don't know, but you get the gist. Look at that. Look at that. How much was there? All right, so 37,000 is now taxable Social Security. So let's go back here and change income. So what did I say? 32. How much did I say was their taxable Social Security? I forgot. 37,000 was their taxable Social Security. 37,000 was their taxable Social Security. And we're going to change this back to 30. Right, so 37,000 was their taxable Social Security. Change this back to 30. And let's see here. How much is taxable Social Security now? 28,000. See, man, isn't that crazy? So the extra $10,000 of income from long-term capital gains made 10,000 more of their Social Security taxable. That's the trap, what they call that, the tax torpedo or something. I don't think it's that big of a deal, but you see what I'm saying? So that extra $10,000 long-term capital gain, not only did it make an extra $10,000 of taxable income or adjusted gross income in terms of their total income, but also brought another $10,000 from Social Security. Does that make sense? Let me show you what I'm talking about here. I'm going to go to the 1040. So here is their taxable income, $28,000. All right, so they have no taxes right there. Again, the tax man, $677. That's, who cares? But Josh, I get it. But if we add another, so here we got 59,000 of AGI, 28,000 of taxable income. So just 59,000 of AGI. Let's just use that. 59,000 of AGI. So we go back to profile, and we're going to increase our income from capital gain to 40,000. All right, blink. How much would that increase our AGI? It went from, what did I say, 58,000? I think I did. To blink to 77,000. Isn't that crazy? So it increased our AGI by $18,000. We didn't add an extra $18,000 of income. We only added 10,000. That's the tax torpedo right there. At the end of the day, you're still sitting at $677 of taxes on $122,000 of income. Whoop-de-doo! But still, that's how you get 0% tax rate, dude. You got your Roth, you got your brokerage accounts, and you got your Social Security. Can't shake a stick of that, baby. Love your thoughts. Again, if these videos help you, don't forget to subscribe to my email list down in the Doobie-Dook. If you want to buy me a cup of coffee, it's in the Doobie-Dook as well. I'm going to be going on live stream tonight at Locals at 8 p.m. Eastern. So for my local subscribers, I'll see you there, and you can join too. That'll be in the Doobie-Dook as well. $5 a month, dude. $5 a month. What? Come on, your old buddy Josh. $5 a month. Come on. Save the clock tower. Save the clock tower. We'll see you.